Please return to your seats and we will proceed with our opening panel discussion. There we go. It's good to see that you enjoy some networking. There'll be plenty of time over the next couple of days for more of that. As I mentioned, we'll have drinks this evening at 5:15 up at the Pool House on level 11, so please do join us for that. And so we're going to kick things off this morning with our funds panel, strategies for an emerging bull market. And I'm delighted to welcome our panelists to the stage in no particular order, well, alphabetical actually. Warren Gilman, Chairman and CEO of CEF Holdings. We have Arnab Sen, Chief Investment Officer of Harbour Capital Management. Scott Marsh, Portfolio Manager at Hawke's Point Capital. And Stephen Yip, who is a partner at Valuestone Global Resources Fund. Gentlemen, if you'd like to join us on the stage. So, as is traditional at these things, we'd like to sort of start things off with a little sort of to set the scene and get a flavour of what investors are thinking about at the moment, how they view the market, the metals market. So, I'm going to start things off with this question about, what key market metrics are telling us about where we are in the cycle? So, who would like to kick us off? How are we doing? Stephen, you're closest to me.
We think we are in the early stage of the recovery part of the cycle. As everybody knows, the market bottomed out in the first quarter of 2016. So anybody who did any investment then 2 years ago would have made lots of money because of the rising tide lifting everybody's investment return. So we think the cycle has still some legs to run, and it's a very good time for investment now.
And when you say the cycle has some time to run, what is your sort of time horizon you're talking about?
We look back 30 years and we notice the resource cycle in the past 30 years lasted about 10 years each, and we are only in the third year of the current cycle. We think that if past history is anything to go by, we should have another 6-7 years to run.
Right. And so Valuestone, tell us a little bit about what you're doing at the moment. So a little background for Valuestone.
We are a 300 million private equity fund sponsored by Jiangxi Copper, the largest copper producer in China. And we started in the middle of 2016, and we have been investing primarily in mining, but not only mining projects. We did two last year, and we just completed our second deal this year. We hope to do 2-3 more deals this year. We are looking at deals around 10 to 30 million, but for larger deals, we can also participate with our parent company, Jiangxi Copper. So far, 3 of the 4 deals we did were public deals, one in a copper mine in Australia, one in a silver lead mine in Idaho, and we are hopeful we close another deal with a Hong Kong listed resource company today.
Fantastic. And as the cycle evolves, do you see your investment approach, the sort of size of deal you'll do, evolving with that?
Our fund limit per investment project is only 30 million, but we regularly look at $100 to $200 million deals. That means we just have to take our sponsor along. We are not deal size limit per se. So we would like to do larger deals if we could, because as we all know, a $5 million deal has the same amount of work as a $30 million deal. We rather spread our resources on larger deals. So there's no limit on that.
So Arnab, Stephen's quite optimistic there and about where we are in the cycle. I guess your thoughts?
Yeah, I guess the question is what are metrics telling us volumes, volatility? I think they tell us not a lot other than that people don't actually know where we are if you look at volumes and volatility. So I guess that history isn't really a good guide to where we are given the amount of central bank intervention that we've had, what the issues that are going on in the world. So I guess we keep it very, very simple. So, you know, you look at John Templeton's quote, which is that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. So you really ask yourself the question, pessimism, skepticism, optimism, euphoria. I think no one would ever say we're in euphoria, but we're certainly not in pessimism. So from a cycle perspective, I think the only thing that makes me reluctant to say that we're still in the skepticism phase is I was at the Goldman's conference in February, and every economist and macroeconomist was bullish because we're finally in a world of synchronized global growth. So I would say that we're in the sort of early stages of maturing on optimism phase, but certainly that's not pervasive in the market right now. So still probably similar, quite bullish for the cycle.
When you're talking about that Goldman's conference, people are sort of, you know, this optimism there. Are you talking about optimism in the general global markets or in the mining sector per se?
I think in general for the macro picture, I think not so much for the markets picture. So there, you know, it's the first time in 8 years we're in a world of synchronized global growth. Everyone's sort of worried that that falls over. I think it will only fall over from something left field like trade wars, because the reality is central banks have worked so hard for 8 years to get into this phase that I don't think that they're going to kill it off very, very quickly by tightening too quickly. So in terms of where we are, I mean, I think although I said that history wasn't a good guide, I mean, the best you can say is probably the analog that makes most sense is the late 1960s, so 66 to 69. You look at what happened in the 60s, you were in sort of a growing inflation market in the first half. You were in a period where unemployment was coming sort of structurally down. If you look at sort of the fiscal stimulus actually makes that even look more closer to where we are today. So if you look at that 66 to 69 analog, you would say that what really worked was sort of a deflation-inflation barbell. So you're looking at, back then it was Nifty 50 and small cap and value. So I would say that that's probably where we are. It's sort of in that small cap value, and really commodities would only work if inflation really starts to take hold. So I think that where we are is definitely in a sort of commodity bull market, but you look at how short that window was 3 years. That's probably where my view is as well, because actually medium term I'm probably in the structural deflation camp, which doesn't lend itself naturally to commodities, but you have a 2 to 3 year window where you should have a very, very aggressive cycle. So as an investor, and we're an investor, what we're looking for, and I think it's similar to the panel here, is that we're looking for companies which are management first, very, very well managed from a capital perspective, but definitely bottom quartile in the cost curve in terms of being a tier one asset, because medium term we still think it's going to be a difficult cycle, even though over the short term we're quite bullish.
And to Harbour Capital, just for those who don't know, what's your sort of size, approach?
We look at small to mid cap companies, and so given we're quite bullish on the cycle here, and we're quite bullish on where demand will be relative to where supply is, and actually supply is very tight in a lot of these commodities, we're looking at taking early stage exploration risk in tier one assets, believing that probably 2 to 3 years from now there will be an M&A cycle starting to kick in finally after God knows how many years, at probably the top of the cycle. So we're really, when you're looking at smaller mid caps, I mean, that sort of 20 to 30 ticket, I think it's really difficult to put to work in a smaller mid cap cycle. You are the investment. So we're looking to put 1 to 5 to work, at the most 10, and obviously work with these companies, because I think that you have a lot of, I would say, lack of capital discipline in this side of the market, and so we're working with them to really grow their business in a sustainable fashion.
Fantastic. And Scott, the view from London. You have 3 Hong Kong-based investors. You're our European representative until Brexit finally takes hold, but our London representative. How's it?
In terms of the view, the mood in London.
Absolutely.
That's a difficult one for me to answer because I think I operate in a space that is atypical, and let me define that. I'm a private equity investor. I'm a long-term investor. I'm a 5 to 10 times return type of money. I've got permanent capital. I think a lot of the money in Europe, let's call it, is institutional money, but it is churn, right? I don't think there's a lot of appetite at the moment for companies to come and get listed in London on AIM or anything like that yet. However, there is potentially money available, particularly in Europe, and a lot of people who come through London, I meet in London, they don't spend a lot of time in London. They spend a lot of time over in Europe itself, trying to get access to money. I think and because I don't deal in that space with those institutionals, I can't comment really on their appetite. I will try and sort of go back to the fundamental question about the secular bull market that we're in, and I have a rhetorical question: is what is a secular bull market? How do you define that? I look at it from two levels. You look at the sort of the market from an S&P 500 Dow type of level, and then you look at it from a commodities level. And I think there are sort of contrasting views going forward there. I mean, you listen to the experts, be it Warren Buffett, Lloyd Blankfein, Bill Gates, those guys, and they're all saying very categorically that there is a significant downturn coming this year in the sort of the equity space, the S&Ps and the Dow and everything like that. So they're very bearish. Jim Rogers thinks we're about to hit a catastrophe in that space. Whereas you talk to people in the commodities level and they're saying actually we're in a secular bull, right? Well, we probably are. And when I think of a secular bull, there are two types of secular bulls. There's a marginal reallocation of capital secular bull out of these institutions into say the precious metal space. Then there's the other type of secular bull, which I would call more fundamental, and it's more policy driven. And a small example of that is the sort of battery technology and the whole EV and all that sort of stuff. That is something that is fundamental. It's driven by people's concerns about the environment. It's driven by a need to develop the next technology to make energy more efficient and distribution of energy more efficient. So I sit there and I say, okay, is there a secular bull in the precious metal space? Yes, there is, but it's driven by reallocation of capital from sort of the equities that are non-commodity invested at the moment into something that they think is a safe haven. Then there's the more fundamental base metal driven, not base driven, sorry, the sort of real economy driven type of secular bull. And I think that is there, definitely. And we've got a long time to go in that. But I think in the meantime, there is a real risk, and I'm not saying this from my own views, because I'm not that smart. It's more about what, you listen to people and the people who are smart, who have made a shed load of money for themselves and the investors over the last 20, 30 years, they're saying there's a big downturn coming. So I think people need to temper a secular bull now, be it in the marginal reallocation of capital secular bull and a fundamental secular bull. There is potentially a huge downturn coming, and we need to get through that.
What is driving this fear of a huge downturn? Is it the fact that the tech stocks, the big tech stocks, so dominate now some of the markets, so those are possibly overvalued and need to come down a bit?
Yeah, I mean, it depends who you listen to. I think the fundamental concern comes down to what quantitative easing has done. There's been a lot of capital that's been put into the market, and that has destroyed price discovery. There's no doubt about it. I mean, there was an interview with Lloyd Blankfein only last week on CNBC, and he was saying that what we've seen in the last 10 years since the last financial crisis has been unprecedented. It's never been done before, and if it was an experiment. Now we're going into quantitative tightening. He's saying that we don't know what's going to happen there either. A lot of the equities, when you look at them from a fundamental sort of earnings perspective, they're way overvalued. Particularly the FANGs, let's call them, the top tech stocks. Their multiples are just out there. Never seen anything like this before in history. And those experts are concerned that when that turns, there's going to be a serious recorrection, 30, 35, 40% type of recorrection. That's their numbers, not mine. So I think that's where the the concern comes from. It's the QE that has inflated these prices. There is a QT coming. However, the QT might not last long, because if there is a downturn, they're going to have to switch back to QE to try and reinflate. What happens through that process, God only knows.
But I guess as QE money mainly went into the sort of the bigger stocks, and didn't really feed into the small cap.
That's right. Certainly not in the mining small caps, and I can't talk a lot about the sort of small caps, sort of industrials, because I don't sort of research that space. You know, a lot of that money obviously hasn't come into the commodities side, and that's where I think there's a reallocation potentially coming into commodities from the institutionals around the world. But as we know, and what we saw in 2007 and 8 is when the market turns, everything turns, right? Gold, silver, everything goes. Correlations go to zero, right? You don't have a correlation. Correlations break, and that's when you have this sort of black swan event. What they're saying is something like that is potentially coming. When? Some are saying this year, some are saying next year. Who knows? You need that black swan event. Maybe that's Trump. We don't know.
Warren, what's your take on the cycle at the moment?
Well, if you'd asked me this, Leo, which I'm sure you did a year ago, I would have been sitting here rather glum, because equity prices and just about everything had gone to the moon. Commodity prices really hadn't moved all that much. So from an investor's perspective, it was really hard to find value, really hard to make an investment. Everything seemed overpriced, and that was across the board in terms of commodities. Here it is, call it 14 months later, you're asking me this question, and my mood has turned 180 degrees. Equity prices for virtually every mining company out there have fallen back to a certain degree of reality. During that time, commodity prices, almost every commodity, has generally risen. So we've got a much better balance now, a year later. So I think the current environment from an investor perspective is a very good one. 2018 would be a good time to put some money to work. Have to be cautious in terms of generalizations, though, because we're in very different points in the cycle for every different commodity we look at. Obviously, one of our biggest investments is in uranium. Uranium is beaten up. Everyone hates it. I don't think there's a uranium company present at the one-to-one conference this year. Is there? Are there two?
There's two.
Okay. So from my perspective, it's a great time to be buying uranium stocks, because longer term, if you can afford to take a longer term investment horizon, these are 10 baggers. They're going to be 10 baggers, whether it's 2 years from now, 5 years from now, I don't know, but I'm going to get my tenfold. Gold. These conferences used to be all gold companies. Now, how many gold companies do we have at the conference?
It's about 40%.
40%.
Used to be about 80%.
No one cares. Gold has no volatility. Gold is trading between 1,200 and 1,350, call it. And it's been that way for 6 years now. 6 years? Why would you put those are dead stocks. Unless you're going to have real great exploration success, that's dead money. You can put your money in things that are going to move up and down 15% in a day if you want. Putting it in gold right now, no one cares. So from an investor perspective, it's probably not a bad time to be buying gold stocks, because no one cares. The whole battery sector, lots of battery sector focused companies here. Probably not the best time in the world for me to be investing in battery stocks, because there's a lot of air in those tires at the moment. Base metals. Base metals, we've all sort of echoed the theme that we've got coordinated global growth. We've got central banks who are reluctant to raise interest rates. We've probably got a pretty good demand cycle. China seems very stable and growing actually more quickly than we've anticipated. It's a pretty good environment for base metals going forward. But because there are so many alternatives, especially in Canada right now, where billions have been siphoned off for cannabis stocks, people have sort of forgotten the base metal story. And they know that 3 years from now, every single base metal is probably going to be higher than it is today. But no one really cares. So the equities, there's a lot of volatility because we've got a bit of a disagreement between the longer-term players and the shorter-term players playing those equities. But generally speaking, they're all pretty lightly valued, if I could put it that way. And they're certainly all 50% of where they were a year ago, when they were tremendously overvalued. So that sort of gives you a bit of an indication of what the upside is just in the near term. So each one of those varies in terms of the short to medium term outlook. But longer term, I think it's a great place to be. It's a great space to be in virtually every one of those commodities that I've mentioned.
This might be a good time to see if we have a question from the audience, actually. Question at the front here. Can we get a microphone? No? He can, yeah.
So last year we saw that we had various global events and they didn't seem to affect the markets at all. The markets just kept going up. And this year, every bit of news that comes out, we see increased volatility. I was a young guy and you saw the Dow or the S&P 500 move 1,000 points. That would have been time to put a rope around your neck. Now it's just a new normal and nobody's really that interested. So given that background between last year and this year, do you think that because of that volatility, money has left the small mid-tier investment space, regardless if it's just leaving tech aside, anything that's small or mid-tier, that money has left that space? Or is it more what you're saying, Warren, where that actually creates opportunities?
It certainly creates opportunity, but I agree with you that in general, that degree of volatility makes people more cautious. They just step away. Let's let everything calm down. Let's wait for everything to find a level. Then I'll put my money to work. I don't want to buy a relatively small cap company today and then have the market drop 1,000 points tomorrow. And this company, even though nothing has changed, is going to be 30% cheaper. So people just stand away. So it generally does make things more difficult and tougher for people in this room. That said, it can't stop you, or it can't get in the way of you doing business. It can't get in the way of me. I can't just pull away. And if I find a good company with good management, with a good ore body, I'm just going to make the investment and not worry about the day-to-day volatility. But it does make it tougher in terms of your daily share price. I think it does have an impact.
We had a dinner last week, actually, with a chap from BHP speaking at the Asia Mining Club. And he was saying that he was talking about buying Escondida many years ago, and said it was quite expensive, and everyone said, and he said, but if they'd bought it for 3, 4, 5 times the amount they spent for it, it still would have been an absolute bargain because it's such a good asset. So
I was just picking up on that question. I mean, I would argue over the last 10 years there really hasn't been long-term money for the small and mid-cap sector, probably not even for the last 20 years. So the reality is that I think the problem for these companies and for these markets is that there just isn't really much long-term capital left. I mean, I think we've almost found the only 4 investors I know who said that they actually have a long-term time horizon up here on the panel. So, the way that the market has moved in terms of vol anchors, consultants, risk limits on, 0.72 used to do a lot of commodity investments here in Asia. They probably don't do any anymore. So the reality is that I don't think my answer to your question is I don't think these companies have ever had long-term money, really. And so it's not really much change in terms of the problem that people have with commodity investments is theoretically the way to make money in commodity investments is to be counter-cyclical. And I'm not sure that many people actually have either the emotional stomach or the actual capital to be counter-cyclical. And so that's why people end up buying at the top of the cycle, investing at the bottom of the cycle. So I think that, to Warren's point, it's a good time to be looking at these small and mid-cap companies. But I don't think we're probably more than 3 months away from it being a very hot market in small and mid caps as we get through this volatile period and actually growth starts to come back, because actually it's just a base effect where PMIs are coming lower right now.
Stephen.
The ups and downs in Dow or S&P 500 has very little to do with valuation of mid and small cap companies. There is, however, so when we make investment decisions, it plays a very small part of an investment decision, but it plays a big role in valuation. When we sit down with a company and we look at, oh, this company's been trading at $1 per share forever. If the management of the company tells us, oh, the market is not reflective of the true value of the company, they want to sell me shares at $3, that would be a very difficult valuation discussion. So the decision itself is based on fundamentals, but the valuation has a bearing on the current trading prices. You come to me and say, the market is all wrong, it really should be worth $3 a share when it's been trading forever at $1. That would not be a very easy valuation discussion.
Any other questions before we move on? Have a little think. I'll come back to you. Oh, actually, Dev, go on.
Warren, what's your view on uranium?
I think you were out of the room, Dev. But I said they were 10-baggers. I said every uranium stock's a 10-bagger. It's just, okay. I'll say it again, Dev. It's a 10-bagger. It's just a matter of when. Is it 2 years from now? Is it 5 years from now? I don't know. But you know it's coming. You just know it's coming. And so, the price of uranium will double, triple. The stocks will go up tenfold. It's just, when is it going to happen?
Let's talk a little bit about some of the macro factors driving global markets. So sort of, obviously we've said that, the S&P is possibly slightly overvalued, the tech stocks a bit high. But what about some of the other things going on in the world? The news cycle is extremely full at the moment. What are some of your thoughts on trade wars, the fall of Trump, etc.?
I don't know if it's a view that's out of favor or contrarian. I'd be very interested to hear what the rest of the panel has to say, but I think it's all noise. The mining business comes down to China. What's demand going to be? And demand is driven just about everything we do by China. How's China doing? China's doing very well. We might have some trade interference, and that might impact the story a little bit, but eventually supply lines adjust, people adjust to trade inconveniences, people build factories in different countries, and it all works out. And it's probably all temporary anyway, because as of November, we've probably got a lame duck president in the US, so nothing will get passed, nothing will happen, which is sort of typical of US politics for the last 15 years. So I think it's all noise. Just look at what China's doing, and if China's okay, we're going to be just fine. Thank you very much.
Yeah, look, I think that what drives global markets has been the same. I mean, it's probably US dollar on one side and China on the other. So, I think that you look at these cycles, supply is a little bit easier to model. You can see what's going on in the world, what's supposed to come into production, et cetera, et cetera. Demand, as you said, Warren, is very, very difficult to model. And that demand, especially in China, is difficult to model given what's happened with letters of credit over the last 3 to 5 years. So I think demand is very difficult to model, but I think people always underestimate where China is. I think Goldman's have 2.1% growth in Chinese demand for copper, and they've got the most bullish price target on the street for copper at 8,000. 2.1% demand for China, does that sound right? I mean, actually they've got a deficit for copper for this year. So I was having this argument with their analyst December of last year, where she said, well, grid capex is coming down, and so demand is coming down, and so we're at 2.1%. She recently came back from a trip March 22nd and said, well, I think it was hidden on page 6 or 7 of her report, actually, so where actually demand for grid is now in distribution, which is actually in copper, which if all of the 477 billion actually went to distribution, you're up 7% on estimates and you're up 3% Y on Y, and actually that would add 2% to Chinese demand. If you add 2% to Chinese demand, which isn't really difficult to see, you're at a 400,000 deficit, 400,000 ton deficit in copper. And then they have flat on air conditioners. I mean, people don't even break down the numbers properly. Air conditioners is 15% of Chinese demand for copper, and then you're looking at air conditioners are up 30% Y on Y. If you believe in the tier 3 to 5 story, I think 1 in 4 houses still has an air conditioner. I think I have 6 in my flat in Hong Kong. I mean, it's ridiculous. So they can afford an air conditioner now. So you go and speak to Haier or some of these white goods manufacturers, and they're saying, actually, we're seeing similar demand this year to last year. They're up 30% Y on Y last year. So if you add in any incremental demand for air conditioners, and you're suddenly at 5 or 6% in China and there's 600,000 ton deficit. So, okay, that's a bull story, but it really, as you said, it really comes down to demand and that demand pull coming from China. People model it very badly, and when you're already top price target on the street, you've got no interest in upping your number at this point in time. You know, you're going to manage it over this next quarter where prices are going to be volatile. You don't want to upgrade just as copper goes down 10%, but it's coming. I mean, I think it's coming. Everyone's very, very light on their numbers on the demand side for China. They all thought it would fall off a cliff, and actually it's going up.
And is that demand side as well something that's going to, we mentioned the battery materials earlier, and people seem to think that there's, you know, that's overinflated, but the demand side on that, with, you know, Tesla now possibly sort of, you know, taking a back step, and some of these other companies, some of these sort of proper car manufacturers coming through, and they're going to be start rolling out EVs.
I don't mean to hog the mic here. I just want to make a point. When I thought the whole battery metal story peaked was back in, when was it, November, December, when we decided to enlist nickel as a battery metal. I mean, nickel is not and never will be driven by batteries. Nickel is stainless steel, and if China hiccups on stainless steel, nickel's gonna hiccup. I don't care how many electric cars we're driving around the streets. So you knew you were getting frothy when you were looking to extend the story to a level of incredulousness. So I think we sort of peaked out on valuation when we started talking about nickel.
Going back to your question about what we're seeing in the world today and what that means, the volatility and everything else, and I would agree with Warren. You know, a lot of that is noise, and it's not going to really affect the supply-demand dynamic of the commodities. However, you know, if there is a major correction at that top level, the FANGs, and that filters through, that will have a short to medium-term effect on the supply-demand, on equity valuations, on commodity prices. I think that there is a correction is due. We've had 10 years of QE, 10 years of inflated asset prices at that level, and I think it goes quite deep in those markets. So if there is a correction, and a lot of people are saying there is going to be, then that will have an immediate effect on our sector in the short to medium term, and then the fundamentals will come back in. As I said, when you have those events, correlations go to pot. They mean nothing until the market, you know, finds its foot again and then starts to turn around. The fundamentals are there, but are the fundamentals strong enough to withstand a tsunami of a correction? I don't think so. However, it's not stopping us from investing. You know, we are still investing. We are still looking at, you know, we're a fundamental investor. We have that 5 to 10 year time horizon. You know, when we look at companies, we look at management first, second, and third, then the asset fourth and fifth. Because if you've got good managers who are managing their balance sheet, managing their cash flow, and are managing the business well, they should be able to survive through the cycle. So we will continue to deploy capital. We're still looking for opportunities out there, but we're aware that there is volatility. And Arnab and I were talking about earlier. There's, you know, when people like us have this 5 to 10 year time horizon, there is going to be volatility. There has to be volatility. But that's where we see potentially some opportunity as well.
Yeah, look, I think talking about EVs is probably topical because there's so many companies here in this market. But I think that probably none of us would argue that battery storage isn't secular, whether it's home power walls or whether it's EVs. I think that what's happened is that is a very, very long-dated view where you've had sort of 3 years where the easy money's been made in a lot of these smaller mid-cap companies, and now you're running into probably the next 3 years where demand is probably going to surprise to the downside relative to where expectations are, and yet you've got probably a pipeline of 1,000 lithium, cobalt companies coming online, and so you've optically looked like you've got oversupply. So I think it's going to be a difficult 2 to 3 years for these mid-cap companies. But I think you look through that cycle, sort of 2020, 2021, and especially mid-2020s when Europe, I think there has been a policy shift to bring EVs in place. Actually, then you'll have a lot of demand, and what you'll actually probably find is most of these juniors won't get funding. I mean, you look at these cobalt companies. I don't think there's been a HPAL project that's come in under $4 billion of capex. They're all talking about $1 billion, $1.5 billion. It's not going to happen that way. And who's going to fund $4 billion of capex? It's going to be very few and far between. So I think that what you've seen, and lithium is probably a good analogy for this. You had a speculative run, did nothing for 2-3 years, then these guys got into production and they were realizing $9,000, $10,000 contract prices, and then the equities have re-rated 4x, and you'll probably see a similar market in cobalt. But right now, the next 2-3 years, you've got what looks like a long pipeline coming in and demand definitely being peak. So I think buying good companies, low cost, high quality management is right, but you're going to have to actually finally think about, investing for 5 years, 7 years, and then you make your 5x, your 10x.
Sure.
One quick comment on investment from China, since I work for the largest Chinese copper producer. If you look at the top Chinese mining companies, you can look at the output, you can look at the reserve. Surprise, surprise, the Chinese investors are not nearly as stupid as you normally think. They have been net adding to their reserve in the past 3 years. They did take advantage of the downturn in commodity, and they went out, they bought reserve. They are net additions to the reserve in the past 3 years. Demand from Chinese company in reserves, in production, just add up their production. They have a net requirement to replenish the reserve. That is the bottom line. They do not want to see the reserve dwindling down. That is the bottom line. You can calculate. They all publish their production schedule a year ahead of time. You can anticipate, calculate with very good accuracy how much they're going to produce, how much reserve they would need to replenish, and they have been adding to the reserve in the past 3 years.
Got a question back here from Andrew.
I'm so old, I think lead is a battery metal. Does anyone on the panel or all of the panel have a view on lead?
Lead.
We invested in a lead zinc silver mine last year. We are looking to acquire a controlling stake in that company, and we are a copper producing company, but lead, zinc, silver, no problem. Chinese resource companies are less driven by what is trendy today. Lithium, cobalt, they are driven by long-term replenishment of reserves.
Fantastic. Just a quick question for you guys. If you are saying that generally there is this sort of secular bull market for commodities, it's looking pretty good, but you think that there's going to be a major correction, it's going to pull all of the equities down, doesn't this create a fantastic opportunity for investors to get in at some rock bottom prices? And if the majors are thinking about resource replacement, isn't that going to create an opportunity for them to suddenly go, right, let's quickly buy some stuff?
Of course, if there's a downturn, if there is, I want it to happen sooner than later. Let's get it over and done with. Let's move on. The longer we wait for it to happen, we're going to have this sort of no man's land that I think to a certain extent we're in at the moment. So yes, and I as soon as that happens, then I think there's huge opportunities for people like us as the investors. In terms of the M&A from the bigger companies, they don't have a good track record of buying the lows and selling at the top. They tend to be to that. And a lot of that probably comes down to, and through no fault of their own, at the end of the day, they're mining companies. They're not investing companies. They're not investment companies. And while the markets are down, they're managing their own balance sheet. They're managing their own cash flows. They're managing their own sort of resources. And when the markets inflate and there's a lot of money swirling around and they've got a lot of cash flow themselves and they've got a lot of debt capacity, that's when they tend to go on the buying spree. So to a certain extent, half their fault, half isn't. It's really not what they should do. And I think a lot of investors would argue they invest in these big companies not for them to go and do investments, because they can do that themselves as an investor. They're investing in these companies to grow their business. So, will they buy at the bottom? I don't think so.
Just, I actually don't think a correction is coming. I think people keep forgetting you have normal corrections within the context of a normal upward-driven cycle. So down 10, 15%, I mean, that's a normal cycle. I think the GFC is still staining people's memories. Now, that's not to say, so I actually think that, okay, we might have a nominal correction over the next quarter, but I'm actually medium-term bullish. But I actually think that correction really comes in 2021, 2022, because global debt is still growing faster than global GDP, and we're going to have a reset. But it's not in the short term. But I agree with Scott. I mean, large mining companies typically buy the top of the cycle and sell the bottom purely because they're not incentivized to do so. CEOs are not incentivized to take risks. So, you always hear this statement, I'm happy to overpay for certainty. Well, guess what? When there's certainty, you're usually towards the top of the cycle. So there's not enough certainty of growth at the moment to see that M&A cycle start right now.
But for the ordinary investor? Good time to be looking. I think that's probably a good time to leave it. That's quite a sort of positive outlook to start the conference off. So can I have a big round of applause for our panelists? Thank you.